Hey guys, Ben from Pivot, and today I'm going to be running through some tax hacks in preparation for the end of the financial year. Running through a bunch of questions that I've been getting around what you can be doing to be smart with your tax. And look, guys, for anyone watching along, please feel free to throw any questions that you've got. G'day, Corey. Feel free, any tax related questions, feel free to throw them into the questions. I'm going to try and cover as many of those as I can as we go through. So, hey, Articus, welcome. G'day, Ness. Any tax questions? Yeah, pop them into the questions, the comments there, and I'll happily cover as many of those as I can. So, the first question that I've got is, what can I do before the end of the financial year to reduce tax? Now, really common question. Obviously, June, not too long in the remaining in the financial year. So there are a couple of things or a few things for you to be thinking about to make sure that you're being as smart as you possibly can before the end of the financial year to maximize your tax refund and to minimize that annual ATO donation. So look, the first thing that is important, and it sounds like a pretty simple one, but essentially to know what's tax deductible. The ATO website is super helpful with this stuff, that they've got a bunch of really interesting and helpful bits of content there that can help you understand, what you can claim based on your occupation, your income sources, and those sorts of things. So look at understanding what's deductible, and keeping good records as well is another thing, because I speak to a lot of people that they want to deduct as much as they possibly can so they can cut their tax bill, but they often don't keep good records, which can make it really difficult to actually claim things at the end of the financial year. Now, the other thing that you can do is bring forward any necessary purchases or necessary deductions before the end of the financial year. So prepaying for insurances, income replacement insurance, those sorts of things. Also, prepaying interest costs is another thing. Interest on investment debt that is deductible. That can really, crank your deductions in the current financial year. Any tax deductible expenses that you've got, you can bring those forward before the end of the financial year, and then you're essentially claiming them a whole year earlier, which means that you end up getting more back in your tax refund 1 year sooner than you otherwise would. Can be a huge help. The other thing, especially with what we've been seeing in the investment markets at the moment, is that selling shares in a loss position. So if you're one of these people that have made a lot of gains, and I know that there's a bunch of people that have made a lot of gains in the last year, if you've got shares that are balanced in a loss position, then selling the shares before the end of the financial year will mean that you've got a capital loss, which you can then offset against your other capital gains, and therefore mean that you're not paying tax on the gains that you otherwise would. So that can work really well. Look at for that one, if you think that's you, look at your portfolio, look at what gains that are there. And in a perfect world, if you're balancing your losses against your gains, it means that you've got no net capital gain, and therefore you can, you're not going to be liable for tax on that. Prepaying insurance fees, interest costs on investment debt is another thing. And if you're getting advice fees, accountant tax advice, strategic investment advice as well, you can bring forward those fees in the current financial year. And again, then you're getting the deductions. You're getting the deductions sooner. Welcome, Vinny Sertralin. I don't know how to say that. Daddy Dan, g'day guys. Feel free, any questions around tax, you can pop those into the comments there as we go through as well. The next question that I want to tackle is, how does tax work when it comes to crypto? This is something that crypto has been increasingly popular over the last little bit, and for good reason. But there is a lot of confusion out there when it comes to how crypto is taxed and what you need to be thinking about around your crypto tax. Now, crypto is like any other tax Yeah, NFT toxic. I can tell you're hopefully already across a bunch of the crypto tax things there. But when it comes to your tax, cryptocurrencies are treated like any other asset or investment. And if you've got a crypto account, then you're probably you might be trading in different shares or buying and selling different shares. Trolls asked if I could sing. Look, I could potentially try and sing one of my tax questions, but it's probably not my forte. Can rock a spreadsheet though, but yeah, singing is not totally my thing since I was in the advanced choir in year 8. So yeah, this also came from a conversation that I had with the client the other day that had a crypto account and had bought a bunch of ETH. The ETH had gone up considerably in value, and then he'd sold down some and had a bunch of cash that was sitting on the platform in the currency exchange. And he was saying that he wasn't sure what to do with the cash and was worried about actually selling or exiting out of the. Thanks, that troll, appreciate it. Was worried about selling out because he thought that might be one of the things that crystallized the tax position. But when we went through and unpacked the detail, and this is something you should confirm with the tax advisor, but because he'd actually sold, then that is a capital gains type event. So it didn't really matter that he thought that because the cash was sitting in his account and he hadn't actually taken the money out, it meant that he wasn't actually liable for any capital gains on the crypto that he had bought. But the reality was, because he had bought some and then sold, then that is considered a gain, which is then taxed accordingly. So essentially, when it comes to the crypto tax, it is treated like any other asset or investment in the eyes of the ATO. And it doesn't matter if the cash stays on the exchange. So you need to keep good records with this stuff. I feel like there's a lot of people that are potentially running into a whole bunch of trouble when it comes to this stuff. But this will be tracked at some point. Ozzy says, is CGT triggered once translation is approved, regardless of whether you touch it or not? Yeah, I think you mean that when you contract to sell or to buy, that's the CGT event when it comes to cryptocurrency. So it doesn't matter if you sell the money in cash or the shares itself. So yeah, that is the actual taxable event. NFT says, I could have owned the gold Invisible Friends, but didn't have ETH when it was released. Yeah, that's painful. Look, I've got a bit of a war story around when I tried to buy a CryptoPunk, and I got a bit scared about sending all of that money into the internet when I didn't fully understand the ins and outs of it back when they were only 20,000 USD. So, that's a bit of a fail, but I feel like we've all got a few war stories on that one. Now, one thing I will just call out when it comes to crypto and tax in particular is that the ATO are going to be tracking this stuff at some point. They will. Oh yeah, thanks for clarifying, Battler. Yeah, it is when the transaction is approved. So it doesn't matter. The transaction being confirmed is the CGT event. So the ATO is going to track this stuff. The records are all there. Yes, it is an anonymous currency in some ways, and potentially, like, if you're a supercomputer whiz, you may be able to sort of confuse stuff and make it harder for someone to track. But my sense is that for most people, the ATO is going to find out about your trades of crypto, and so it probably makes sense to be reporting them sooner and be keeping good records, because otherwise you're potentially going to be faced with a tax bill at a time that you're not wanting it or not making sense. So I think it's a little bit reckless to think that it's not going to catch up with you. In my view, it probably will. So yeah, I think keeping good records and being prepared for the tax side of things as well. So g'day, Susie. And yeah, look, for anyone, feel free to pop any questions into the comments and I'll cover them off as we go through. Next question. What can I do to stay in the lower tax brackets? And this is something that I get a lot from people, and they're getting a bonus or a pay rise or a promotion or taking a new job. And they're worried because the new income is going to push them into a higher tax bracket, and they're worried because the marginal tax rate system works in Australia where the more money you earn, the higher your marginal tax bracket becomes. But something that a lot of people get confused about is the fact that when you go into the next tax bracket, the higher marginal tax rate only applies on the income earned in that bracket. So what I mean by that is, like, if say the top marginal tax bracket in Australia is $180,000, if you're earning $160,000 and then you get a $40,000 pay rise that pushes you up to $200K, you've now got $20,000 of income that's above the top marginal tax bracket. It's only that top $20,000 of income that is taxed at the higher marginal tax rate. The income that you earn between $160,000 and $120,000 is still taxed at the tax rate in that bracket, and then the income earned in the lower brackets is taxed at the rate of the lower bracket. So, with the exception of HEX payments or fee help or whatever words make the most sense for you around that, the only thing that there is no point where you earn more money and then end up with less money after tax. It's always good to get a pay rise. It's always good to get a bonus. So keep that in mind when you're having your conversations at performance review time with work. But it is only on that extra bit of income. So HEX is a bit of a call out because there are different fee help HEX repayment rates. So when you go into higher brackets, it can mean that you're paying down more of your HEX debt or forced to pay more of your HEX debt. But at the end of the day, you probably have to get rid of that debt at some point anyway. So not the end of the world. And you are still earning more money after tax as well. Next question I've got. G'day, Lisa. Welcome. And yeah, any questions as we're going through, pop those ones in. Next question is, can I get tax deductions to buy a property? And yeah, look, I get the appeal with this one that you ideally look to, buying property tax deductible would be fantastic. Look, the short answer is no when it comes to buying, say, your home necessarily, but there are a few things that are that do make this possible. One is if you use a self-managed super fund, you can actually make tax deductible contributions into your super fund and then use your superannuation money to borrow and buy a property. That can be a great way to build up your assets, get into the property market sooner, and essentially both buy a property and then pay down the mortgage debt tax deductibly. But if you're buying a property inside your super, you need to be aware that it does come with pretty considerable costs, both to set up the mortgages on properties that on superannuation owned properties are generally a little bit more expensive than what you pay in standard mortgage interest rates. So that's something that you want to be across as well. But yeah, if you're saving, 39% or 47% in tax, then it can be a huge advantage. It's only right for people in the right circumstances, though. So do get some good advice if you're thinking that might be something for you. The other way that you can get tax deductions to buy property is with the First Home Super Saver Scheme. The government have recently changed the rules with this so that you can essentially put $50,000 into your superannuation and claim a tax deduction for that money, and then use the money to buy property, which is pretty huge, especially when you consider that for a couple, you're potentially going to be able to get $100,000 of tax deductions and then take the money out of super to buy a property. There are some risks with this, and when you put in money into your superannuation, it is invested in the market. And what that means is that if the markets go down, like what we're seeing at the moment, could be that your money's taken down because of the weird rules around how that scheme works, can mean that you withdraw more than you actually put in, and then essentially are raiding your super. But look, again, it can help you get into the property market sooner. And because of the power of property investing, in my opinion, can be good overall. Another thing to really look out for is on the tax brackets, because the tax rules are a little complicated with that scheme, but essentially you pay 15% tax on the way into super. When you take the money out, you pay tax at your marginal tax rate, but with a 30% tax offset. which if your tax bracket is increasing, if it goes from 0% to 50%, then it can mean that you're taxed more on the money when it comes out as well. So if you're thinking about going down this path, you're talking about big decisions. So make sure that you understand the rules before you jump in. Another question I've got here is, what's the best way for salaried employees to cut their tax bill, to cut your tax bill? Look, this is a common one, but a pretty tricky one. You know, as a salaried employee, like just a regular, ordinary employee of a company, i.e., not someone that's self-employed or running their own business, that it is a little bit limited in terms of what you can do to get tax deductions, because you don't have a lot of control on how your income is paid. So you will want to understand your deductions. Deductions are the biggest one, but by far and away, the biggest area for salaried employees to save on their tax obligations is by where and what they invest into. Now, this is a really big one that a lot of people don't really so much think about, but whether you invest in, say, Australian shares that pay nice frank dividends that come with a tax credit, or you invest in international shares that don't have any of those dividends, that makes a big difference. If you, as part of a couple, if you're investing in someone with a lower tax brackets income or not, then that makes a big difference to the tax that you pay. Negative gearing on property can make a big difference on the tax that you pay, because all of these strategies that you still see the same headline numbers, but it's only really after the tax is paid that you end up with your net return, which is really what matters. So you want to, as a salaried employee, to cut your tax bill, understand those deductions, but then be smart with your investing, and you're going to be placed to get the best tax outcomes possible. Also, maybe start a business, then you get a little bit more control in terms of how you structure things as well. Although I totally get that that's not really practical for everybody. Another question, I got this one the other day, is just around what my favorite tax saving strategies are. G'day, Akira. So favorite tax saving strategies. The first one, and I love this one, is debt recycling. That's where it works for people that own their own home, that have non-tax deductible home loan debt. And how the strategy works is that you've got your home mortgage, which is not deductible. You essentially have a new investment only loan that's attached to your home mortgage, borrowing generally at property mortgage interest rates, which are lower interest rates. You pay down so you might have, say, you got $1,000 a month in surplus cash flow. You pay down that $1,000 onto the non-tax deductible home loan debt, and at the same time take $1,000 out of your newly created investment only debt, and then invest that money into the share market. Because the purpose of that debt is for investments, it means that the interest payments on that debt is tax deductible. And over time, what happens is you pay down the non-deductible home loan mortgage debt, and you increase your tax deductible investment debt, which is why they call it debt recycling. You recycle down non-deductible debt, create deductible debt, you build a nice chunky share portfolio in the process, and get tens of thousands of dollars of tax deductions every single year. So it can be a really great way to pay down your mortgage faster, build a good investment portfolio, and get a bunch of tax deductions in the process. My second favorite tax strategy is negative gearing. And with negative gearing, I like because of the tax benefits that come with it. So buying property that's running at a loss and claiming a tax deduction. But more than actually the tax benefits that I like from negative gearing is just the simple benefits of gearing, because gearing just means borrowing to invest. And property is the most common way that we do this in Australia. When you you save up $100,000 and you're thinking, do I buy shares or do I buy property? You could put your $100,000 into $100,000 worth of shares, and that would be great. You choose great shares, and then that It must deliver that income to another tax-paying entity, which gives you a lot of flexibility in terms of who pays the tax on the income. Now, if you've got a couple, one person's at a lower tax rate bracket, it might be like someone's on maternity leave, time out of the workforce, children or whatever. It can mean that you can, in 1 year, you can distribute more income to them, pay a much lower tax rate. Whereas in future years, if that changes, then you've got flexibility again. Also, with a trust, you can direct income to an investment company, which has a maximum tax rate of 30%. And that is significantly lower than the top marginal tax bracket in Australia. So if you're looking to build a significant investment income over time, then having it taxed at 30% compared to 47%, it's going to save you tens of thousands of dollars every single year. My fourth and final tax saving strategy is around insuring your income. Now, I get that everyone thinks that they're bulletproof and insurance is sort of boring, but income replacement insurance is something that's fully tax deductible, and it pays you every single month if you can't work because of accident, illness, injury, like any sort of other reason. Your income, if you're younger, it's generally your biggest asset, much more than your investment property or any other asset or investment that you might have. So I think it's an important one to ensure. I unfortunately see a few of the horror stories of people that don't have insurance in place. I also get to see the big difference that it can make when you do have this insurance in place and the shit hits the fan. So I think getting this in place, get some tax deductions, give yourself a good peace of mind. I think it's a good strategy. My next question here, Majestic, welcome. And look, for anyone watching along, please feel free to throw any questions into the comments there as we go through. What are the biggest tax mistakes for business owners? And this is a really common one because business owners do have a lot of tax obligations, a lot of tax opportunity as well. The first mistake that I see for business owners is not really understanding what their tax obligations are, especially if you fall into a business because you've got a passion or you get some interest or there's something happens and you get an immediate, like there's a need or an opportunity that comes up. If you don't understand your tax obligations, you can run into serious trouble. GST, BAS reporting, like all of these things, you got to know what they are so that you can prepare for them. Get good help as well. I learned that lesson the hard way when I started my business, that I had someone that I thought was good, but wasn't. And that caused a lot of headaches that I had to unwork. This bookkeeper that had reported things in the wrong way. And thankfully, it didn't cost me too much money. It didn't cost me any money with the ATO, but it did cost me money to get another professional to sort out that work. So knowing what you don't know is important here, because it's often pretty difficult if you're not experienced with this stuff to realize who's good and who knows what they're talking about and who doesn't. So, get a good recommendation, speak to a professional that knows, and make sure that whoever is helping you is right to be doing that. The other big mistake that I see for business owners is not having their businesses structured in the right way. So, between trust, operating company, there's a few different options in terms of how that can be structured, but having the right entity structure to support what it is that you're looking to do, both in your business and in your personal wealth building, can get quite complicated with this. So make sure that you've got good help there as well. Also, that structure is one of the big drivers of how you build wealth over time. So you need to make sure, if for example, if you want to buy a lot of property, you need to have a mechanism to extract profits out of your entity group to be able to fund that and to be able to borrow and those sorts of things. Whereas if you don't, then, using trust sets with the investment company can mean you can stream income, cap your tax rate at 30%, build a big share portfolio right off into the sunset. So the difference between something that's sort of good and something that's really good is huge from a tax perspective. So it's something that you want to get right. My next question is, what are some of the tax deductions that people don't know about? And a couple of these things I've already mentioned in the content here, but financial investment advice is something that a lot of people don't realize. So when you're getting someone to give you advice around managing your investments, these fees are generally deductible and can help you build your wealth and build your assets and your investments and give you some deductions at the same time. Home office utilities and expenses around that, because we've all been working from our COVID bunkers. I think you know, if you are incurring expenses for your home office, then these are things that are deductible: travel costs and fees for your investments as well. And my last question that I've got here is, what are the best options to pay less tax? Some of these things I've already touched on here, but I think it's worth repeating. Know your tax deductions and maximize them. Invest tax smart, choose the right investments, invest with the right person, the right entity, and have the right strategy. Use different tax entities when they're appropriate. That's the third thing. So whether you use trust, super, individuals, companies, whatever. Huge difference from a tax time perspective. Fourth one, again, maybe not practical for everybody, but start a business. So that gives you a lot of flexibility. You know, people working in contracts can structure their incomes in different ways, give them a lot more flexibility with managing those tax outcomes. So guys, look, we pay a lot of tax in Australia. We've got one of the highest tax rates in the world, and it seems to be increasing every year. Who knows what the impact will be as a result of the election, but it really pays to get smart here. So hopefully those tips help. Really appreciate all the questions and comments in there. And guys, I will catch you on the next one.